Good afternoon, everybody. It looks like we've got a number of participants that have already joined, and so we'll get started. This is being recorded, so you'll have the ability to send this on to folks that have missed it. We're very excited to have you join us here for our quarterly economic update. My name is Chris Atkins. I'm the lead of our C2FO Capital Finance Group, which finances invoices and inventory outside of C2FO's network. And with me is Eric, the lead economist at UMB, and he has a great presentation here for us. And we'll try to make this fairly conversational and get through the material. But this is obviously there's a lot going on. We're excited to talk about it. It's obviously a lot of fun because it's a bit volatile, but it also has considerable implications to you as business owner, finance executive, and on. One quick reminder, kind of on the housekeeping side, is so we're on Zoom. There's a Q&A. If you kind of hover your mouse towards the bottom of your screen, there's a Q&A function. There's also a chat function. I'll be monitoring both. So as you see me look off to my right, I'll be monitoring both of those for questions. Try to consolidate those. Bring timely ones to Eric. If you have a thought or anything like that, we would love to have that interaction, and that's the way to do it. So both Q&A and chat will work on that, and I'll monitor both. With that, though, I'll hand it off to Eric, who will lead us through his presentation, and again, we'll just try to make it kind of conversational here and welcome your questions as you have them. So thanks again for being with us, Eric.
Hey, everybody. It's good to see everyone again. I'm going to share presentation mode with everybody. And Chris, you can tell me if it looks like, do you see a nice presentation mode?
It's good.
Okay. Chris and I talked, Matt and I talked before as well. And the topic that I'm getting hit with a lot right now is the same one everyone's hearing about on TV and wherever else, is inflation. The story is coming from every direction, and as folks in the finance industry, us as a bank, you folks in your industries, inflation is a big story because it tells us what we think might happen with interest rates. So it's a very, very hot subject right now. We're calling it, it's getting hot in here, and wanted to just show some of the reasons that these inflation numbers are doing what they're doing. And at first, we'll just look at the things that everyone is obviously feeling. Incomes and savings are way, 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 way up. It's been pretty incredible what's happened there. What's happened with the housing market. We'll take a peek at that. All of that drives spending. And of course, we'll look hard at inflation itself and just look through some of the data and the charts that we like to follow to help sort of illustrate what's happening right now. And we'll finish up with what we think is really going on. So that's what to expect. Starting with incomes and savings. And I know we've talked about it before. You've seen in some of the charts I've shown you before, Chris and I talked about it a lot when we were getting ready for this presentation. Wages and salaries, it's kind of astounding what has happened in our country with wages and salaries. Now, this is earned income that you see on this graph. This does not include any transfer payments from the federal government. That's why it did drop at the start of the recession, because this is just the earned wages and salaries. And what's amazing is the speed on the right-hand side with which it recovered during the recession, got back to where it was before, and now we're well above where we were before this recession started in plain old earned income without any help from the government. And that is despite the fact that there's quite a few people still not working, which we'll look at later. So the income story it's just awesome. It's amazing that our incomes have recovered this quick. And that's one of those things that's pretty. Go ahead, Chris.
Yeah, Eric, this is just aggregate income, right? So if you take everybody's salaries, right, everybody's income on an aggregate basis, it's in the U.S. it's $10 trillion. Right?
The entire nation had wages and salaries at an annualized pace of $10.2 trillion at the last read, which was at the end of May, I think is when they took the last set of data. But way above where it was at the start of the recession, which is pretty mind-blowing, really, with everything that's going on.
Like you said, that doesn't include transfer payments. And so obviously not all of the, call it 4 trillion, 5 trillion that was printed ends up, additive to that 10, right? Because you're going to have a lot of CARES Act shows up in business that then pays personal income. But some of these, like the child care tax credit just started. I
Yep.
think a lot of us with kids just started receiving that, and then the other direct payments that would be additive to this 10 trillion, right?
Absolutely. Yeah. And this doesn't even include things like investment income,
Mhm.
rental income and dividends and all those things. This is literally just wages and salaries. So the very most basic measure of income, and it's incredible with how it looks. So that's one of the things contributing to all the heat. And the next slide, we looked at it last time that we all got together and talked. You've had a huge spike in what they call the money supply. There's a lot of different ways of looking at it. This thing right here is the M2 money supply, which is one of the broadest measures of just cash. How much cash? Corporations and people, how much do they have parked in all the different accounts that they have everywhere? And we're above 20 trillion right now in cash reserves, and it's pretty unusual in a recession to have money supply rapidly expanding. That's again unusual. That's what happens when you drop $5 trillion on a group of folks, and it's not that it's $20 trillion. That's not the number, because it's a big number in normal times and it grows every year. But this growth rate that we saw just in these last few years, basically last 18 months, there's basically $5 trillion of excess cash reserves parked in everyone's checking accounts and savings accounts that would not have been there had we not gone through a recession. And that's a really weird thing to say, Chris. It almost makes you think, thank God we went through the recession. But this is the money that got printed up and distributed out, and a large percentage of it ended up in savings. And so we have really something like $5 trillion in extra reserves sitting around, and that's what fuels some of the activity that we're seeing right now. That's making things feel a little crazy.
Well, and if you just think about it from a basic level, right? When you think about economic activity, which is fueled by the amount of supply, like cash supply that's out there, uh, if it doesn't slow down considerably, then you're going to have increasing prices, right? Because the supply increased,
You
right?
would
And
think.
obviously we've seen that in assets.
Yep,
Now,
you're seeing a lot of money chasing some pockets of assets, and that is what drives inflation up. Because, of course, because of the shutdown, we're constrained on the supply side, and
Mhm.
everyone is feeling that as well. There's products that have serious supply constraints, but there's a massive amount of money available to buy them, and that's how this whole thing adds together. It's sort of textbook. A lot of dollars chasing a constrained supply, and things start to really heat up. And another thing that is kind of astounding. What's happened to your house. Even in Kansas City or wherever you are, what's going on with housing prices. What's going on with other prices out there, and what's happened in the stock market. And that adds up to an incredible trend in household net worth, which is what we have here. Just total U.S. household net worth, which is now at $137 trillion. Net worth, net of all debt. And what's incredible is the spike that occurred. It dipped a little bit at the start of the recession, and then we've just had a massive rebound. That's extra cash. That's higher price for my home. That's higher price for my stock and retirement portfolios. And we've seen a spike in net worth that we've never seen before. That's one of the most rapid climbs we've ever seen in history. And it just is more fuel for the fire. Regular folks like you, Chris, my income looks really good. I got a lot of extra cash in savings, and my net worth is the highest it's ever been. I am definitely willing to spend money and into a market where things are kind of constrained. So it sets us up for a lot of the things that we see going on right now. The jobs market is under a lot of pressure, and there's a lot of this is like many of the charts. It's all-time highs almost everywhere we look. Job openings in the United States, 9.2 million unfilled jobs, highest level we've ever seen in the United States. And on the right-hand side, this thing that's tied directly to inflation, which will show how this pulls through to inflation a little bit later. But it's a thing called the quits rate, and it's the percentage of the workforce that is voluntarily separating from work each month. Literally just voluntarily separating, and usually that means leaving for a better job. And the quits rate has had this massive spike and is now up to, again, all-time highs. Everything above about 2.4 are record highs on the quits rate. Record numbers of people leaving their job for a better job right now. Record numbers of jobs available. It just feeds all those things we're talking about. Everybody, pretty much everybody in most industries knows they can find another job somewhere else. It adds to your confidence, and you got all that cash, and you have all that net worth, and your income looks good. It gets people, a lot of folks, ready and willing to do a lot of economic activity.
So this is, Eric, this is a monthly percentage, right?
Yeah. Yeah. The Bureau of Labor Statistics, and this one actually comes from a place called JOLTS, JOLTS, compiles a bunch of stuff every month. They survey businesses on quits and people job hopping and difficulty of finding people and all those other kinds of things. And they update it each month. And it's been spectacular. It makes sense when job openings are moving like this. The quits rate is going to be moving along with it. It does make sense, but everything is hitting new all-time highs just everywhere we turn.
Yep.
It's kind of amazing.
As most of us that are, hiring or running teams have seen, the move to remote has allowed just a kind of a flattening of the world that hadn't existed before. But I want to draw attention to, so if it's at 2.5% and persists about that, that means that 30% of people per year are moving around.
If it stayed there, moving
so
from job to job.
Just an incredible, I think long run efficiency, right? If remote work continues, but short run, terribly inefficient for our economy.
It's challenging. It just in my team, we've had, my team is a living embodiment of these two charts. I mean, we've had a big spike in the last 9 months of folks just moving to quote unquote better jobs. And to your point, Chris, in probably half of those instances, it was because of the work for home availability. I'm going to work for a company out of Pittsburgh, and they're going to let me live right here and work in they told me I can live anywhere in the world. I mean, our people are hearing that, and it allows everyone to recruit anyone if you're in the electronic world. And so it really exacerbates all these problems. It's great for workers. It's a great time to be a worker in the United States. It's a challenging time for employers for sure. It makes it really rough. Pulls through just this, obviously, they also survey how many businesses are reporting the jobs are hard to fill. Of course, it's going to be up. And again, new all-time highs on hard to fill. All those.
Definition on that. Do you have any idea?
This is a survey. These are literally surveys. Yeah, they do. They call around and do business surveys, and what percentage are saying that their jobs are hard to fill. So that's direct feedback from business owners. And that's intuitive. You would know that would be the case. Now, this is a big topic that folks on the call might be hearing about. One of the things fueling this problem that we're having is this thing called the participation rate. And if you want to know the details, this is the percentage of the working age population that is participating in the workforce. And that includes the unemployed. That means if you are working or looking for work, you're participating in the workforce. And it's, again, in not all-time highs, we're sitting around at all-time lows here. We had a huge drop when there's a huge number of people that just leave and shut down and stop looking for work when we had the stimulus checks. And some of that has come back, but we're still a full, call it 2.5, maybe more percentage points below what our normal level would be for workforce participation in the United States. And what that means is something like 7 million, maybe 8 million folks that were working 18 months ago and are not working or looking for work now. They have left the workforce. They're no longer participating. That's driving all those other problems we saw on the other charts. It's a really, really key component of what's happening on all those other charts. And so this is a huge one for all the economists out there, is if the stimulus checks drop off in September, if we start really tapering off and eliminating the special stimulus, do all of these people come back? Do half of them come back? We talked a little yesterday when we were getting ready for the call. We know for sure they've already done surveys and figured out that at least 1, maybe 2 million of these folks have taken early retirement. They're below the age of 65, but they have officially announced that they are taking retirement. So we're not getting 7 or 8 million back. We probably, our best case is maybe we get 5 or 6. It's going to be really a linchpin kind of a thing. If the checks stop flowing, you would think most of these people would come back. If we elect to continue to extend and extend and extend those checks, we could have a very long-term shortage of workers, and it will keep all these constraints in place that we just talked about. It'll be hard to hire people. It'll make wages go up. It'll cause all kinds of things. So this is a real important topic.
I think this also wraps into the all-time record net worth, right? Because it's a bit circular, right? Because because I think you mentioned in our prep that that a bunch of the 1 to 2 million was actually Gen X, which is just astounding, right? I mean, obviously Gen X is getting to that kind of 55, depending on how you define it, mark. But at 55, I mean, you obviously got to have, with life expectancy on average for another 25 years from then, you've got to have considerable net worth. So one of the benefits, obviously we're going to talk a bit about inflation here, and Shara, hopefully I'm not butchering that, Shara, your pronunciation was wanting to know about the long term here.
Yeah.
Right? Long term, it sounds like we've lost 1 to 2 million of workers, primarily because of net worth. But what we could see, one of the benefits of if we do run into inflation that we all kind of hope we don't really see, one of the benefits might be that the equation changes, and that that nest egg may not last, so you can see a return.
You hit on already. My response to your question is we've never been through anything like this, so we don't know for sure. But they do know that historically, early retirees, and that's basically people below the age of 65, but especially the people between 55 and 62, a very high percentage of them end up going back to the workforce. Now, maybe it's in a reduced role. They used to make 200 grand a year, high pressure job, and they do something else for 70 grand a year with plenty of time off or whatever. And the last study I saw was something like 50% of those retirees in that young retiree bucket end up coming back. Now, this was a huge spike. We don't know. So let's say it was 2 million, maybe only 1 million of them really stay fully retired permanently. But your point is well taken. If the markets change, if you're 58 and the markets change and your net worth drops a little bit, maybe you change your mind anyway. And you have a tendency to change your mind anyway if you retire really, really young. So we'll see. We would hope, economically, we would all hope that most of these people come back to work.
Well, I think it also speaks to, for those of us that are trying to hire, and obviously there are generational differences here, but as we think about hiring for our teams, when money becomes less of an issue, you got to find other drivers for those folks, right? Mm-hmm. And so, for one of the hot buttons, obviously for the millennial and especially Gen Z, is meaning in work, right? Mission orientation. And I would just suspect that as folks, like you said, maybe the 55-year-old that had the pressure cooker job says, I'm done with this, but then figures out in 2 or 3 years that they've done enough fishing and golfing and such. Yep. They may be looking for that $70,000 job that is it just has a lot more meaning. And so I think as we struggle through, especially needing folks in house and maybe not remote, or maybe remote, just those of us that are hiring, thinking more about how does this contribute to society and not just an economic way, will help attract those that don't have economic issues. It's more of a what am I going to do with my time issue.
Yeah, and totally personal opinion. I think you're correct, and a personal opinion on that would be that could be a really nice solution for us socially. If you had a couple million or 1 million early retirees a couple years from now, just said, hey, I want to come back and do something and help out, and they might be able to fill a really nice spot if they came back a couple years later without massive expectations on income or other things. It could be a really good solution for the future. So we'll see. All of these things add up to these pockets that are on fire. You know what's happened with housing. I put this in here because probably everybody's heard about it, or heard about their neighbor who sold their house, or the fifth time they heard about somebody sold their house for 10% over asking price in one day. That's everywhere in the country. That is almost everywhere in the world right now. It is actually quite a bit worse in Canada, Australia, New Zealand, Northern Europe. It's quite a bit worse than it is in the United States. Everything is even more on fire there housing wise. But for us, this is U.S. home prices year over year change. They update this every month. In April, we had one of the largest up months in history, and we're now 15% as a country year over year. And I put this section in here because immediately people think, oh my God, housing bubble. Here we go again. I went through this once before. This is terrifying. The price movements and sort of the frenzy that we're all hearing about, you better get over here. It'll sell in 2 hours. That scares us all because of what we lived through, but this is not the same thing. And this next few slides, I just wanted to illustrate that this is not a housing bubble situation. And this one is a pretty simple one. If you look on the left-hand side, this is what happened during that housing bubble period. We remember 04, 05, 06. There was 48 months in a row that the year over year price appreciation was 15%. So it was 15% for 4 years sequentially. We just now ticked up to that very rapidly for the first time at the last update for, was it May or June? So if this continues for a few more years, then the price movement would be something you might say is bubblish. Right now, it's sort of shocking to see it happen in your own backyard, but even the price movement is not bubblish yet. It really isn't.
Yeah, and that's a good point. I think these charts can be really tough to read because if you don't pay really keen attention to where the zero is, it just doesn't
Right there.
seem like the left. Yeah, the left side of this chart means considerable. I mean, you're talking about it's probably about 15% on average for almost 6 years.
Yep.
Right. And that's obviously unsustainable. And I think that, and you've trained me well now going through this a couple times. I think what you're really looking for is what's going on in affordability.
Yeah.
Right?
Yeah. Yep. Right into the next topic. And that's also crucially important because affordability, it looks nothing like the housing bubble. And this is one of the key ways they do it. This is an outside vendor. I just grabbed the chart because it was so easy. They've debt service payments as a percentage of the disposable income, and debt service payments for the vast majority of homeowners, it is dominated by your mortgage payment. And you can see right here, this is where we were at the peak of the housing bubble. And this is where we are now, even with all that price appreciation and people paying 10% over and all these hot markets. Debt service as a percentage of disposable income is fantastic. It's very low, a huge difference from where we were. So the average household, even with these prices they're paying, the affordability of those homes is very, very, very high relative to their income stream. So they're in good shape. People are in good shape to make these transactions they're making. That's for sure.
Yeah, disposable income here being just after tax income.
After tax, yep.
Yeah, so I think things that could affect this, right? Interest rates, that's the easy one. But if it's after tax, then tax could affect it too. I think we live in a much lower tax regime, obviously because of Trump era policies, and that may change. So that could affect it. Anything else that would kind of be
no, that would be it. I mean, that would be it. I mean, because most of these folks, even today, since a thing that we learned in the Great Recession in the housing bubble, most folks are very wisely terming out this debt. It's fixed debt, usually for 30 years. So their rate is not going to move around on them very much.
Wait,
the only thing that would get them would be the disruption of their income.
So that as somebody that was in banking back, before the Great Recession and helped clean it up at the FDIC. So debt service, this is contractual debt service. So when WAMU was doing 130%, interest, kind of half interest loans, that's baked into the 13%. So you actually had a lower debt service than you would today. And does that make sense?
You mean were they really capturing it back then?
Right.
Yeah, they were not. No, there were so many things going on back then. It was worse. To Chris's point, it was worse than it even looked on this chart back in those days.
Yeah, if you had termed everything out over 30 years, it probably would have been, just based on what I saw. And I was in a hot market in Colorado, but what I saw, I would think that this would be kind of 16, 17, maybe even
Yeah.
20%
Yeah,
versus.
and it's nothing like that. Now, lending standards are much, much better. Down payments are much, much better. Everything's cleaner.
Yep.
Actually, that's the next point. Here's a good one: loan to values. And now, keep in mind, this is the Fed doing aggregate loan to values for all the data they can find in the whole country on all mortgages. But again, it's the same. You had this reckless lending standard, what Chris was just talking about at WAMU and some other places, that just sent loan to values in aggregate way up. And for many, many households, keep in mind, this is in aggregate. There were many, many, many people that were the new participants in the market then that had 90, 100%, 125% loan to values. And there's always a lot of older folks that have, very low mortgage balances. So, but in aggregate, we went up to 50% back in the bad old days. And right now, you can see how much better everyone stands for, just in terms of their leverage and their loan to value on their mortgage. Much, much, much better than it was. And we're back to 40, 50 years ago type of levels in terms of how much leverage people have against their homes. So this is a really good indicator. Even with those really high prices that people are paying and accelerating prices everywhere, still the leverage against them is very, very manageable. So this doesn't look like the last time. It's housing bubble now, not right now.
Is the long run average roughly in the 32, 35% range?
It depends on how you define long run. And I've never run this chart. I don't know how far back we could run the chart. Probably, I think we could probably get it back even in before the 50s. The 35 to 40 is my perception of where it was for a long time. Now, if you include, it probably would be wise to do it X the mid 2000s.
Mm-hmm.
And just say, carve out this 6 or 7 years. And then what's the average been, but for those 6 or 7 years, it might be about 35.
And what's crazy to me is when you look at the very high inflation days that you have circled over to the left, and yet you still had roughly lower, right? So people were still coming up with larger down payments and making progress on amortization.
Yeah, lending standards were very, very strict back then, very strict. And we're getting back to much stricter lending standards. So it means that the housing market, despite all the noise around it, it's healthy, and consumers that are doing these transactions are healthy, which is a good thing. And this chart just is a way of showing you how much people have actually paid down their debt burden, which is evident in those other charts that we looked at. This is just one version of it. Consumer credit, how much consumer credit's out there. And that's the one area that people really use those stimulus checks on. We know that it appears that the stimulus checks in aggregate now for everybody, and I don't want to be political or anything, but everyone knows a lot of folks who probably got stimulus checks that did not need them. My children got them and said, why do I have this money? I don't understand. I mean, they both have good jobs. They know that it's been roughly 30, 30, 30. About 30% of the total amount of the stimulus checks that went out was used to pay for living expenses. They noted about 30% of it we used to pay down debt, which is a good thing. And about 30% of it went into savings. That's what they're guessing has happened. And this is just an evidence of the debt pay down. We just had this massive pay down in consumer credit. And it coincides with the flow of the stimulus checks and the surplus savings. So there's no big surprise there either. Consumers are in really, really good shape. And it does pull through to something that's probably near and dear to the folks on the phone with us or on the call. Definitely to my company as a bank and commercial lending bank. Income is fantastic everywhere. Reserves are very, very high everywhere. Typically, that means there's not a lot of hunger for debt out there. And this is just a very broad measure, a loan to deposit ratio of all the commercial banks, all the domestic chartered commercial banks in the country. Loan to deposit, how many loans do we have outstanding versus how many deposits we have coming in? You can see where it was during the peak of the housing crisis. It was above 100%, above 1.0. It's usually much higher than it is now. It's all the way down to 0.6. All-time lows for loan to deposit ratios. That just means banks, at least, have the lowest amount of demand for their credit products that we've ever seen right now. It makes sense. When incomes are high and savings are high, people don't need to borrow a lot, especially when the economy is partially shut down. So it's kind of a perfect storm for lending institutions. Lots of cash, lots of income, and a very, very shut down economy. People don't borrowing money right now. So that what that tells you also though is, again, unlike 0506, banks are in fantastic shape. I mean, bank balance sheets are very, very clean. The loan quality is very, very high, and the amount of loans we have outstanding is very, very low. So banks are, I mean, that's nothing like 0506. Those banks, the banking industry was just a mess back then. So things are looking pretty good out there.
So
And everybody knows the stock
sorry,
market.
Eric,
Go ahead,
back
Chris.
that loan to deposit. So the alternatives, just to land this for those that aren't bankers, the alternatives are non-loan things, right? So the bank just doesn't have 40% sitting around in cash, right? They're doing things like lending to other banks that maybe have a higher loan to deposit, or buying securities, or buying treasuries or something like that, right?
Absolutely. We park it somewhere. It has to go somewhere. We could theoretically leave it idle at the Fed, but it would be so damaging to our earnings that that would be unacceptable for a publicly traded company to do that. So yeah, it's parked in other instruments. Loans are always our most lucrative instruments. Lending is the highest, what we call interest margin, is what we're always trying to find. Trying to find margin. And we're working on net interest margin, and loans is what we need to really hit our net interest margin targets. When we don't have enough loan demand, then it's in bond portfolios or lent out to other banks that want to lend it somewhere. It's always working somewhere, but it's not as lucrative when the charts look like this.
Yeah. And so that means that there's fewer direct loans, right? So there's other credit products out there that might be from alternative finance folks or stuff like that. Because I think there is a kind of a structural trend towards alternative lenders, versus banks. But certainly isn't 40% in the last 13 years, 14
Correct. Yeah, there's no doubt about that. And just the final piece of the puzzle that's making things really hot, it goes back to that net worth we talked about. It's even with what's happened the last few days, and we've had a big recovery the last couple of days. But you had 31% S&P 500 returns in 19. You had 18.5 in 2020 in a recession. 18.5% return on the stock market. You couldn't have made that up. You could never have forecasted that. But we made 31 and then 18, and just it was about a week and a half ago when I did this slide, we were already up another 17 just halfway through 2021. So it fuels the optimism, and it fuels that net worth feeling and the wealth effect and all those kind of things. So a lot of things have set us up for activity. And when you combine that with low workforce participation, so that there's supply constraints in a lot of different places, everyone knows the stories of the crazy spikes that we've seen. I'm in the crosshairs of this one, and that's why I put it on here, Chris. Of course, 4 months ago, my daughter tells me, 24, but I told her I would help her buy her first car after college. I told her that, Dad, my car's dying. It's time to go. In the middle of what you see here on this chart, Carmageddon. Used car prices up 45% in 1 year. And of course, that's a moonshot off the scales. No one's ever seen anything like this ever before. But that's just the culmination of all these things we're talking about. People have money, they have incomes, they have jobs. A lot of people aren't working. It's creating supply constraints. That's how this kind of thing happens. So some of this stuff is just crazy, the numbers that are coming through.
Just to draw the attention to the left there, wasn't the 2010 action, that was cash for clunkers, right?
There was clunkers, and even with that, you only had like, what was that, 12, 13%.
Right.
I mean, this is unlike anything we've ever seen ever. I mean, people, if unfortunately, if they're shopping for a used car, I mean, people are seeing that you have used cars trading literally 1 or 2 or 5% below new car prices. And it just doesn't make sense, but the transactions are still happening.
It doesn't make sense until you're sitting there with a giant net worth, stimulus checks, a broken car, and a need for a car, right? Like, and you can't get a new one because there's no chips, right?
Yeah, so if you have to go, and I may be that guy biting the bullet. I don't know, Chris. I'm telling you, man. If my daughter's car, if it dies, to your point, if her car dies tomorrow, we will be those people because gotta have a car.
At 45% appreciation, I think you got about 1,000 people that'll sell you a car.
Yeah, yeah, no kidding there.
You got a couple.
But yeah, and this all adds up to inflation. It's not a bad story, but when these components are in place, you start to get inflation, and everyone has heard about it. Especially last month, everybody heard when we posted the new June numbers for inflation. Everything had spiked, and that's year over year changes in prices. This blue line, the CPI number, which is the sort of the broadest, most commonly talked about one, people kind of freaked out because it was even above 5% year over year. The Fed immediately came in and said, listen, this is transitory, their favorite word of the moment. It is transitory, it's to be expected, and it was to be expected because this is a 1-year price change. Well, you go back to April, May, June of last year, the depths of the recession, prices were down. And so when you move a year forward and you're in recovery, you're going to have some big price jumps. So the Fed was being totally fair when they said this is totally expected. It should happen this way, and it should. They're saying it's transitory and it's going to roll back down. It's not going to stick. And so we want to look at why they would be saying this is transitory. You know, if nobody can find workers, if we see what's happening to different areas, how can they possibly think it's going to be transitory? And I put this chart on here, and I'm going to introduce, if you haven't heard the phrase, the Fed likes to look first. They don't like CPI. CPI is the big broad one you hear about on TV all day, the Consumer Price Index. The Fed likes a thing called PCE. It's a little bit less housing related, and that's why they like PCE, but they also like a special measure of that they perform at the Dallas Fed, and it's called trimmed mean PCE. And they seek to take out any component that's extremely volatile. People have heard that we want to look at core inflation because it takes out food and energy. Food and energy are just too volatile. Let's take those out. That's what core CPI and core PCE are. The Fed says that even that measure is too volatile because of like what you just saw with automobiles. They're saying we don't want those types of things kicking our measure around, so they have a version called the trimmed mean, and that's a really fancy way of saying they have a sophisticated methodology of cutting out the most volatile top and bottom every month. And they don't care what it is. They don't care if it's food and energy. They just want to remove the volatility from up and down. They cut out the top and bottom, totaling 15%, and they follow the trimmed mean. And that's what the green line shows here. And that's why the Fed says, hold on, don't react to these movements up above 3% that you just saw in June. Our trimmed mean inflation numbers are telling us that inflation really hasn't taken off. It's just these little pockets. And if you remove the pockets that are flying up and down, you see something that's really right around that 2% number that they're totally comfortable with. So that's one reason the Fed is sort of, I guess, steadfast in saying, relax, don't worry, it's transitory, it's transitory, it's transitory. Does that make sense, Chris?
Yeah, I mean, and this is intuitive too, right? I mean, I think, I think a lot of people have digested a Bain paper back from the early teens. I think it was 2011, called a World Awash in Money, where they talked about when you have so much in savings, and this is back before we printed 5 trillion and resupply, probably another 2 or 3, that you're just going to have asset class spikes, right? And we also know, as folks that are in business, that exclusivity can drive demand, right? And so I think we're seeing collision of a lot of that. And certainly, I get the trimmed mean PCE and how that could make sense. Obviously, I don't know that we're out of the woods yet. I mean, I get, hey, let's hang on for a minute. But when you've got so many different things on, whether it's oil that is up just absolutely considerably, all of us, when we go to the grocery store, it's more than it was a year ago. And then, if you need to, get more space for your house or for you buy another car. I mean, the pricing is just silly at this point. It just feels like it's going to have to.
It's shocking. It really is. And I tell you why what you're saying is really important. What you're saying is the way a lot of people feel. A lot of people have this gut feeling man, something really powerful is happening that for most of us, we've not felt before. We've not been in a situation like this before. If you're old enough to have lived through the 80s, you know what inflation feels like. But the rest of the folks that weren't, like say, at least 10 or 15 years old in the 80s, this is the first time we've ever seen things like this happen. But that's also great lead into the next slide. That's why the Fed, this is backward looking. That's on the screen right now. That's actual measured inflation in the rearview mirror. More important to them is this thing called expectations. And it's exactly what you're talking about. What is everybody reporting their expectation for future inflation is, because it's a huge driver of behavior. It's a very huge driver of behavior. And so they follow inflation expectations from a number of different sources, and that's what you see on this chart here. And there's dozens of different versions, and there's dozens of different timeframes. I pulled the 5-year inflation estimates, and they come from different sources. One source being professional forecasters, one being markets, meaning specifically the bond market. What is the bond market saying the path of inflation is going to be? And then consumer expectations. They survey people, and they call you up, Chris, and they hear what you think about it, and you express what you just expressed. They track all of those things because they are a very important indicator for where inflation probably is headed. Because if we're worried about inflation, necessities will start to accelerate those because we're afraid they're going to be 40% more expensive in 6 months. And so it really does influence behavior. And what you see here is over this last period of time since March of last year, all the different measures of inflation have been rising. Expectations, forward looking. Over the next 5 years, what do you expect inflation will average? They were at 1.5 before the recession started. Now they're 100 basis points higher, and they've been moving for 6, 8, 9 months. All of them up in this 2.5% range, with consumers, like you just expressed, having the highest estimation. The consumer expectations are always the highest. The consumer expectations for inflation are always quite a bit higher than the professional and the market. But when all of them move, all of them at the same time in the same direction, that gets the Fed's attention. That gets their attention. But they would also say, look, the average of everyone's expectations is that it's only going to be 2.5% or so over the next 5 years. That means that they're probably right about these 5% numbers we just saw. The world is saying they expect those actually are going to roll over and come down, and maybe we'll settle in at 2.5 or so. And the Fed thinks at this point in time they'll be comfortable with that. We shall see if they're really comfortable with 2.5, but they say they're going to be.
And so to me, if you're going to design a system, right, from just a very high level, you would want it to look like this. Now, maybe not the price movement, but I just think what is interesting to me is if you want to drive demand, you would have higher consumer inflation expectations than actual, right? Because if we as a group of consumers go, holy cow, my dollar is worth more today than it's going to be tomorrow, then that helps drive some demand. Now, like you said, if long run actually stays at 2.5, I don't know that they're going to be actually comfortable with that, right? Because it starts to creep up there. And I just, I hear it, but there's a lot of money out there, and what I know from a lot of supply is it ends up with a bit more demand, and I think we're going to see more than we expect right now, but.
Well, and that leads into the next part where I'll try to real quickly illustrate why this may not be specifically why you feel that way, Chris, but why a lot of people feel the same way you do, that they may not be that comfortable if it settles in at 2.5. And the reason is those of us who've watched the different cycles happen, we look at what happened last time. And I'll try to just illustrate it real quickly for you why some people are a little worried about all this. Now we're going back in time. If you look here, this is that last cycle we talked about, that 04, 05, 06, 07. All these next slides are the last cycle. And we talked about the quits rate and how it had hit an all-time high. Well, not the Fed, economists would normally tell us when the quits rate gets above 2, you have to start paying attention. And so this is the last cycle. Quits rate moved up above 2. That meant the job market was tightening up. People were jumping around, like we talked about. And just as a reminder, right now, our quits rate is way up here off the top of this chart. We're up around 2.7. So that's just a reminder. Then what happened, I'm going to drop this graph down a little bit and put a new one on top of it. So here's that quits rate on the bottom. It pushed wages higher. This is one of the many, but this is the Atlanta Fed wage tracker. And so when the quits rate got up there to 2 and it was able to stay above 2, wages started pushing up to this critical level above 3.5. That's an important number. When wages are growing at 3.5% or more in aggregate in the United States, other things start to happen. And the last cycle was just textbook. Quits rate got above 2, wages got above 3.5. And I'll drop those down and drop the next one. Look what happened to inflation. This is core PCE, that one that the Fed likes. Look what happened. As soon as we got up above 3.5 on wages, inflation pushed up above 2 and stayed above 2 for a very long time, and actually even pushed up to 2.5. And to your point, why some of the Fed members may not be comfortable with some of these numbers, we'll drop on here what the Fed did during that cycle. So this is all that stuff. And now we just have highlighted the inflation number and Fed funds interest rates. Last time was textbook. The moment inflation broke above 2%, the Fed started tightening, because 2% is their target, right? They're not going to be that way this time. We know that. But the moment it moved above, they started tightening, and they kept tightening, and they kept tightening, and they kept tightening. And inflation did not respond. Inflation kept grinding higher. And the last time, by the time you got to 06, Fed had tightened 400 basis points, and inflation kept moving up and moved up to 2.5, that number we were just talking about. So the last cycle we had illustrated that it's not that easy to control inflation with a lot of precision. And once it gets rolling, it's not just a no-brainer that you just tighten a couple of times and it comes right back down to where you want it. This slide shows us why folks that lived through this, or at least watched these statistics when they happened last time, it's not the simplest thing in the world to manage. And so that's why I think it plays perfectly into what you just said. We'll see if they actually are comfortable. If it's transitory and it comes down and it only comes down to 2.5 and stays there, they may not be as comfortable as they're saying they are, because of what they all saw last time. They saw it. This thing is not real easy to control. So does that all make sense, Chris, the way I laid that out?
Yeah, but I think that so two things that pop out to me. One, this was on the back of an obviously unsustainable housing rally, right? That was fueled by really just toxic debt, right? That it just didn't make a lot of sense. So that's kind of to the negative of, well, maybe it's a bit different. The other thing, though, that swings, for me more towards, this could be more serious, is we also didn't print $5 trillion, right?
Absolutely.
So this was in an environment where dollars were a bit tighter, right? And just if you look at government, not, again, like you've said, not trying to be political, but just the reality of the regime. We didn't get to a looser monetary policy until the end of this chart, right?
Yeah.
Where we printed a trillion for TARP and $1 trillion for the next one. I can't remember the name.
Yeah.
Right. And so and then obviously that money kind of disappeared into the ether.
Yeah.
So yeah, there's just, to me, there's a lot more money, and asset prices are, they're moving, obviously not moving like they were last time. So
yeah, you're exactly right. The sort of the fundamental pieces are falling in place. No cycle is exactly like the last time, for sure. But then you sprinkle $5 trillion on top of it, it keeps people awake at night. It really does. It's going to be the thing that is the biggest risk to all of our forecasts. Is it all hotter than we think it is, including the Fed? That's clearly the number one risk. But it's just interesting. It's very interesting what's happened.
Historically speaking, sorry, just back on I remember a study on Fed funds, or at least prime, that it just rarely moved over 2% over a shorter than 3-year period, right? And so to have 4% over 2 years, obviously that's pretty considerable. And so I think that's what, just to put the super fine point on it, that's what everybody's concerned about, right? Is that you have adjustable mortgages, which there's not a ton of those out anymore, but floating rate debt that goes from 1% there, or 0.5% plus their 3, and then that suddenly goes from 3.5 to 7, right? And that's
And,
obviously material for
and
businesses.
it did not slow inflation down much at all. So
Right.
it's a good reminder.
Yeah.
It's a good reminder of how things can unfold. So we certainly have to be cautious. This one, I'll do this slide, then I'll wrap it up and we can go to questions. This is just illustrating, as opposed to this cycle that we just looked at, where the quits rate pushed the wages up and it caused all these other things to happen. The quits rate, we know, is up to that's the yellow line, is up to these all-time highs. But the other 3 lines are different measures of wages. And interestingly, this time, the wage numbers aren't showing up yet. You had a spike when all the low-paying workers were removed from the workforce. They knew that happened because they leave the calculation. And then when they start coming back, then it plummets. So the big spike and the big drop in average hourly earnings, you smooth that out. But even smoothed out, like there's that Atlanta wage tracker we were talking about. It was above 3.5 shortly, but it's been turning down lately. Employment cost index, another version, it's been trending down lately. We'll have to see where this average hourly earnings number comes in after this data washes out, but it's not behaving like it did in the past. It's not. It's the same methodology of calculation each time. And this time the wage number has not gone into the danger zone. So this is another reason the Fed looks at their numbers and says, hey, relax, we're not seeing it. This is something else they can point to. They can say the wages just haven't pulled through yet, which a lot of people think, yeah, I say it's crazy. Everyone we had a number of people, like I said, jumped to more, I guess might say, more flexible job environments. Well, now we have to pay up to get them replaced, and everybody is going through the same thing. So it's frustrating to see that in aggregate, the wage numbers aren't really growing that fast, and it may be about to change. I mean, we will see if most of those people that are not working don't come back. If they stay on the sidelines, these wage numbers could take off, and we could have a much hotter story coming our way. I don't know. We'll see.
Yeah, and to me, this is what makes it so difficult, right? Is that you don't have a good analog for this in history, right? Where you remove so many lower paying wages, and then when you bring them back, they earn less, right? Because it'd be tough to say that restaurants are as full as they were pre-pandemic, right? Where
Sure.
waitresses are getting tipped at the level that they were, right? So if she used to make $20 an hour, now it's 15 for for the same exact job, even if she's got it, right? So it's, to me, this is what makes it so tough is, experientially, it seems like wages are definitely up, but then you see this chart and you're like, okay, well,
Not
we'll
yet.
see over the next 6-9 months
Yeah.
if it's just kind of the bias of one circle, or if it's if it is structurally that they are going up and there's some weirdness in the data.
Yeah, we'll see. This is one that if it hooked back up, it couldn't surprise anybody. That's for sure. We all know
Real
what's
quick,
going on.
sorry, Eric. Since we're running a little bit short on time, if you
Yeah.
have questions, start throwing those in there, because this last part's pretty quick for Eric.
Yeah. If you have questions, put them in. This is just a summary. Obviously, GDP this year we know is going to be a strong number. It's going to be 6% probably. After this year, we'll probably still be able to have a 3.5% number next year, which is still a really strong number. But then we're going to settle into what we're calling the Great Plateau, a world of probably 2.5% GDP growth after we get past next year, which is fine. It was fine for the last 10 years. It'll be fine for the next 10. For interest rates, we have kind of a modest view of interest rates. We think the Fed's going to be incredibly cautious, and we're in the camp that the inflation thing is going to settle back down. And I guess we'd say our base case is it's not going to take off to that world well above 2.5. So we think the Fed is going to stay on hold. This is our 3 different timeframes. Blue line is end of this year. We think the Fed will still be on hold. We do think the 10-year is going to be moving back up to 175, which is just where it was a few weeks ago. End of next year, we think the Fed will still be on hold, maybe a little controversial there, but we do think the market's going to be preparing for some Fed moves, so the long end will be up above 2. And if you want to talk really longer term out to 2025, we do think they will have been on the move, and we'll have overnight rates up to 1.5 and probably the 10-year up around 3. Now, those are higher rates, but those are definitely manageable. Those aren't the types of things that disrupt any cycles. I'll skip that one because we went in detail on that last time. So just the summary: GDP good this year, pretty good next year also. Unemployment falling down to 4.9. Fed funds on hold, 10-year 175. I just told you, and we think S&P 500 stock market. I think right now is at about 14 or 15% on the year. I think with the sell-off we had, we think we're going to finish the year in this high teens to 20% range. So we still think there's a little more upside for the stock market, and so we're cautiously optimistic. I mean, we did a good job of talking about all the risks that are building up out there, but we think it's still time to be optimistic about things. Bottom line. So, any questions from the outside?
Yeah, we've got one. It's about let's see. So she says, how has the PPP loan impacted the check on inflation? How have additional unemployment benefits impacted people returning to work? I don't know if you have a sense on that last one. I'll see if I can get clarification on the first one.
Yeah, the last one is the unemployment benefits preventing people coming back to work. It's controversial and it's kind of a political hot potato, but I don't think there's any doubt that that's why there's a few million extra people there, because we know the people that entered the unemployment rolls. We know that they were those folks you were just talking about. They were the lower end of the wage earning spectrum, and the unemployment benefits were generous enough. They made an economically rational decision. If I can make 90% of what I was making before staying at home, economically, it's rational to just stay home and not deal with all those issues. So they did not make irrational decisions to do that. And so the extension of those benefits in the states where they're being extended, we would be in the camp that is definitely keeping people from going back to work. And hopefully in September, purely economically, I'm not saying that it's good for someone that has daycare issues to have to suddenly deal with, oh my God, I have these daycare issues. I know that the human side of it is different, but economically, it would be best if the benefits rolled off and most of those people got back to work. That helps our economy better. There's lots of personal issues in there though. And the PPP question was, what impact the PPP on what was
Well,
it?
I think the meat of that question is that PPP has largely run its course, right?
Yeah.
So I think, to me, what I'm thinking about in terms of folks coming back to work is, PPP is exhausted for everybody except for those that really figured out how to, thread the needle on the system. But I just don't understand a scenario where that would have worked, and then and it still be running. But really, do you have a sense for the percentage of the U.S. or percentage of states or anything like that where unemployment benefits are still ongoing if you were kind of a casualty of COVID?
I don't have the exact numbers, but I think it's fallen to, I think it's just a tick below or above half that have already let them start to run off.
Okay.
So the trend is definitely seems to be in place that most states are going to let these things run off, which once again, economically, that's a I can make the case economically for families. There's arguments about it. I understand that part, but
Yeah. Okay. So I got some clarification on the first question, and I can't remember. I should remember this because I did the PPP webinars. My gut says it was somewhere in the 1 trillion range of total PPP money, maybe 800 million or 800 billion. Is that about right?
correct. Yeah, that's the number, and it went out very, very quickly too. It went out the door fast.
And so I think it's the question is related to inflation. Would that help keep inflation down? My gut says no. That it just helps keep. If anything, it would make inflation go up because people weren't hurting as much. And
well, the argument, you could argue that it helped keep inflation down, perhaps in that it kept people on the payrolls. It kept people on the payrolls at companies that might otherwise have just been closed.
Mm-hmm.
So I guess it's not really the case that it helped ease wage pressure. I don't think that it did. I don't think it. My best guess would be that the PPP did not have a significant impact on inflation. It was so early. It was mostly a way of keeping people employed, sort of as an emergency measure. I don't think it's probably going to be looked at as something that had a big contribution to the inflation story.
Makes sense. All right. Well, as always, Eric, we really appreciate you joining us. And for those that joined by webcast and are listening to this recording or watching this recording hereafter, really appreciate your interest and look forward to doing it again next quarter. Thank you for all the questions. And as always, thank you, Eric, for showing us kind of the paradox here that we're sitting in and giving some good commentary around how we should be thinking about it as business leaders. We do
My
appreciate it.
pleasure. It's good to see everybody again.
All right, everybody, take care.
Thanks. Bye.